You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. All right, let's jump into last week's paper trade that we looked at. We were in Moderna, and overall, there's been some fairly decent news about the results of the vaccine in Moderna. And so we went out and we looked at a strategy. We looked at a variation of a strategy that we've talked about a lot on Options Playbook Radio. We looked at the synthetic relationship to a long call spread. We had done quite a few strategies overall. We're a little bit neutral to bullish on the underlying stock. We'd like to buy a little bit in the money call option and sell a little bit at the money call option. Well, the synthetic relationship to that long call spread is a short put spread. And we talked about the benefits of doing a short put spread relative to a long call spread, especially if you are correct on your forecast, think the underlying market's going to go up. And then we also looked at, some of the detriments too, because there's always an upside and a downside to any option strategy that you're looking at. So on Moderna, the underlying stock last week was trading right around 220. It was up fairly well on the day. We now see that market at 234.98. And I should mention, we are taping Options Playbook Radio on June 30th. The markets are closed right now. So we wanted the market to go up. We needed it to stay above 220. Where it was trading last week, and it's definitely done that. The trade is still live. It goes out until the end of this week, which would be the July 2nd expiration this Friday. But ideally, you just want to close it out. If you have to give up a nickel or so, usually do that. It's usually much easier than trying to gain that last nickel, take all the risk that's involved on the trade. And on top of it, it makes it easier for the risk departments at brokerage firms. Why is that? Well, you have options that are expiring, so they're always going to take a look at those positions and see what the obligations may be on that position overall. So I just like to take everything out of their hands. I'd like to try to get into that position all in one trade, try to close it out all in one trade, try to get as much of that $5 overall for the width of the spread. So we did this entire trade for a net credit of $2.60 to the account. If we can close it out and basically pay a nickel for that trade, that would be great. If not, the options would expire worthless and you would make that whole $2.60. And that was one of the benefits of doing a short put spread, is that if you are correct on your forecast, the value of the puts would basically go to zero. That means they would expire worthless at expiration. You wouldn't have to pay any commissions to get out of the trade, but you'd still have to pay commissions to get in. So since there's really nothing to adjust on that trade, we're just going to run out and look at another trade. We've got a very simple trade today. We've had a lot of news on the banks this week. A lot of the banks are looking at doing buybacks, maybe increasing their dividend. They had their big audit. Things in general look fairly good. A lot of those banks are going to be announcing earnings. We have Goldman Sachs on the 13th of July, also along with JP Morgan. Bank of America is announcing on the 14th. So we're just going to do a FOMO trade. We've talked about this before, where as opposed to going out and trying to pick a bank, overall the industry seems to be solid. And we had a little bit of a downturn recently. The Fed basically came out and said that they're a little bit more concerned about inflation than initially thought. They didn't really make any big statements, and they very rarely do. But for some reason, the marketplace kind of took that as a bearish sign, and some of the banks and financials sold off a little bit. They've kind of bounced back since then. So now we're going into earnings season. After their big audit, everything seems to be doing well. The banks have gone up a little bit since the news. A lot of banks have came out and said they're going to be increasing dividends. They're going to be doing some buybacks. So before these earnings, we're just going to do a FOMO trade. We're going to go out to 2022. We're going to go out to January 2022, and we're going to buy an in-the-money put option, and we're going to do it in the XLF. That is the ETF that actually tracks the banks. Now, part of the reason why we're going to do it in the XLF is the XLF is a fairly inexpensive ETF overall. It's trading at $36.69 right now with the markets closed. We're going to go out to that January 21st expiration, 2022. 33 strike call, which happens to be the 78 delta call option, which means that we're going to pay for this a little bit. We're going to go a little deep into money. We're going to get a lot of intrinsic value overall. And we're going to put up about 12% of the actual stock price. So ideally, if you bought 100 shares of the XLF, you'd be putting up $3,669 based off of the close. And we're going to come in and we're going to buy one call option that is trading at about $4.60. That's somewhere in the midpoint there. That would be $460. So if you did the math on that, that's about 12.5% of the actual stock price, or about 12.5% of the total investment that you would need to actually put in to buy 100 shares of that stock. So when we're doing this trade, we're limiting it to 12.5%, but a lot of people might say we're limiting our risk to that 12.5%, but a lot of people might come out and say, well, I don't want to lose 12.5% on this position. So when we're doing this as a fear of missing out type trade going into earnings, obviously you wouldn't do this trade unless you anticipated some good news in the financials after they announce earnings in general. And once again, it's not meant to be a recommendation, but I do want to talk to you, as usual on Options Playbook Radio. What we're really looking to do is try to implement a bunch of different option strategies. So if I'm going to do the fear of missing out trade, we're going to buy this deeper in the money call option. Why are we doing it on the XLF as opposed to picking one particular bank or one particular financial that we might like and actually placing the trade on that position? Well, first of all, there is safety in numbers, right? The XLF, it owns a bunch of different financials, so it doesn't have as much volatility. So overall, that means that, the upside, it's not as volatile, but also to the downside, it's not as volatile as compared to an individual bank or an individual stock overall. Another way to say that is it has a little bit lower beta in general. And when we're also looking at buying an option as an alternative to buying the stock outright, one of the issues with buying longer-term options on individual stocks is a lot of times they'll have wider bid-ask spreads. They might have a little bit more implied volatility. Implied volatility will a lot of times affect bid-ask spreads overall, and in general, the more liquid the underlying, as far as the stock is concerned, or the ETF in this case, the more liquid the option contracts will be. And the XLF is one of the most heavily traded ETFs in the marketplace. So very good liquidity. So if I go out to the January 21st, 2022 33 strike call, I see the bid ask right now with the market closed at 440 by 470. Now it's still 30 cents, but as compared to the stock, which is only a penny wide, it's still a little bit shocking overall. But you can try to work the order a little bit. There's some volume, there's some open interest in this specific option contract. And I would probably enter my order in right around $4.60 right now to see if I could get that fill on that trade. But my biggest thing here is that you are taking a position. You're putting up 12.5%. That's the maximum you can risk on this. You don't want to miss out if the news is good. If the news is bad, oh well, I limited my risk. It goes to the downside, and I'm actually going to follow it fairly closely. We got the underlying stock trading at 36.69. We're buying the 33 strike call. If the stock did come down to 33, that's basically my stopping point. So I'm not necessarily risking the entire amount. Normally when I'm doing these FOMO trades, and I've talked about them a lot here on Options Playbook Radio, that's my stop point. I put the trade on. I think the market's going to do well. I want to ride them into earnings. I want to get into it a little bit before the earnings. We don't want the big jump up in implied volatility the day of the announcements on a lot of these stocks. And so we go out and we buy this at a decent price. And if the underlying comes down to our strike, well, then we got a stop point. That's when we want to go out. Because since we're long an option contract, ideally all the time premium is set right on at the money options. So if I buy this option contract and the market goes up, I actually gain momentum. The delta is going to start out fairly close to 80. As it goes up, it's going to approach 1, never going beyond 1. But on the upside, I'm going to gain delta. As the market comes down, though, I lose delta. So if it's going against me, it's going to go against me slower. And the most ideal time to actually sell an option contract that you are losing money on is when you can get the most time premium for that. And usually the bulk of the time premium is right around the at-the-money option contract. So here's our plan. We're going to go out and we are going to buy an XLF longer-term option. We're going to go out to January 21 in the year 2022. That's 205 days out. We're going to buy an 80 delta option contract, and that contract would be the 33 strike call. We're looking to pay about $4.60 for that, or $460. That's about 12.5% of the current stock price. If we were thinking about buying 100 shares of the XLF, we're just going to buy one call option. We're going to limit our risk. We're going to have that position. If the market comes down to 33, well, we're going to get out of that position. So if it comes down a little bit, we're talking maybe about 10% or so, then we're just going to say, well, I guess we were wrong, and we're going to sell it, and we're going to move on and go look for another trade, knowing that we did limit our risk and we did accomplish our goal. All right, so that's going to be it for this episode of Options Playbook Radio. If you have any questions you would like to send me, please send them to theoptionsguy@invest.ally.com. Please follow me on Twitter. My handle is @BrianOverby. And that will be it for this episode of Options Playbook Radio. Until the next time, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or Search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.